Talk technicals. Fairlead Strategies founder Katie Stockton calling the recent downturn in the market after a brief summer rally. She expects the stock slump to continue through the first half of 2023. Katie Stockton, founder and managing partner of Fairlead Strategies, joins us now. Katie, how would we know whether we're on the cusp of something even worse than what you've been talking about? And there's a lot to worry about fundamentally. There's a lot of reasons why you could see something like that. You've talked about below 3,600. Do we need a capitulation bottom that gets the VIX much higher than it is, or is it different this time? And if we did see a 35 VIX, what would that equate to on the S&P? And I guess it depends on how quickly it happens, but it could be worse than 3,000, couldn't it?
It definitely could be. And I think the worry is that it's not 35 for the VIX, but actually 80, 90, like we've seen in past bear market cycles. So that would suggest that we certainly could have worse to come. And I think really what we're doing in our work is just trusting the downtrend and respecting the negative long-term momentum. Of course, now also the market has negative short-term momentum, and we don't want to fight against that. So as much as we want the market to bottom, just like everybody else, we don't want to get in front of it when it still has this downside momentum.
It's a little bit disconcerting that sometimes technicals can inform fundamentals. Because there are some people that think, all right, the bad news is kind of in front of us in terms of what the Fed has to do. But if the technicals are telling us that we could go much, much lower, then maybe we need to ratchet up the fears that we have about, what the Fed is actually facing and how stubborn inflation actually might be. So technicals can actually tell you you're not negative enough about fundamentals.
That's right. So one could argue that sentiment is actually too complacent considering all those concerns are out there. And what we look at are levels to understand what downside risk might be for major indices like the S&P 500. You mentioned 3,000. That's not a key level for us, but 3,200 is. That is a long-term Fibonacci retracement level, and it would be targeted by a breakdown below 3815, which is another Fibonacci retracement level. So we look for breakdowns to be confirmed. We always like to see a couple of weeks below a level, especially a big level like that, to assign a new downside target. But that 3,200 would be targeted by that kind of breakdown. And as you know, 3815 really isn't that far away. We saw the relief rally in the summer, very short-lived, very difficult to capture on the upside. It saw an immediate shift in market sentiment that to me was somewhat disconcerting. People are very willing to jump on board, especially in the high growth arena. And what we've seen is that the relief rallies in high growth are leading now to retests of support. So those names that had downtrended came off their lows, people got excited about it, added exposure. Now they're dealing with, in some cases, more than a full retracement of their gains. Names like NVIDIA is probably the most high-profile example of a name that had a retest that was unsuccessful, meaning it took out the support from the summertime low.